Most Canadians spend decades building toward retirement. They contribute to their RRSP. They pay into CPP their entire working life. They make sure their mortgage is paid off. And then one day, the paychecks stop, and they're finally retired. And that's when something happens that nobody warned them about. Because the day your employment income stops, your tax situation starts to change in quiet ways that don't announce themselves. The CRA doesn't send you a letter. Nobody books you a meeting. There's no orientation. A lot of Canadians discover these changes the hard way, when they get their first notice of assessment as a retiree and realize they owe thousands of dollars they hadn't planned for. In this video, I'm going to walk you through 5 specific things that change from a tax and financial standpoint the day you retire in Canada, with real numbers, real examples, and a clear explanation of exactly what you can do about each one. Stay to the end. The 5th one surprises people who have been retired for years. Before we get into the 5 changes, I want to be precise about what I mean, because the word takes away in the title needs some nuance. The CRA doesn't show up on your last day of work and confiscate anything. Your CPP isn't canceled. Your savings don't get clawed back just for retiring. None of that happens. What does happen is more subtle, and in some ways, more expensive. When you were working, the tax system was mostly automated. Your employer withheld income tax from every paycheck. Your CPP contributions were deducted before the money ever hit your bank account. Tax was handled before you even saw it. Retirement changes that. Suddenly, you're managing multiple income streams, some taxable, some not, with different withholding rules, different thresholds, and different interactions with each other. The rules haven't changed, but your relationship to them has completely shifted. And here's the part that catches people. Several tax advantages that existed only because you were employed quietly disappear, while new calculations come into play that didn't apply to you before. If nobody walks you through these changes, you can lose thousands of dollars simply because you didn't know the landscape had shifted. So let's go through all 5, one by one. This is the change most Canadians assume they understand, and most don't quite. When you were working, your employer handled your taxes. Every paycheck had CPP contributions and income tax deducted automatically. You filed your return every spring, maybe got a small refund, and moved on. The system handled itself. In retirement, that system disappears, and what replaces it, if you're not paying attention, can lead to a surprising tax bill. Here's why. When you stop working, your employment income drops to 0, but most retirees replace that income with a mix of other sources: Canada Pension Plan, Old Age Security, RRSP withdrawals, RRIF withdrawals, possibly a workplace pension, possibly investment income, possibly some part-time work. Each of these income sources has its own withholding rules, and some have no withholding at all. CPP is fully taxable income. The maximum monthly CPP at age 65 in 2026 is $1,507.65, but the average Canadian receiving CPP in 2026 gets somewhere closer to $830 to $925 a month, depending on their contribution history. Important to know, CPP payments don't automatically have tax withheld. You have to request it. If you don't, you'll owe the tax of filing. And if you owe more than $3,000 in a year, the CRA requires you to pay quarterly tax installments rather than waiting until April. OAS is also taxable. The maximum OAS for those aged 65 to 74 in 2026 is $742.31 per month. For those 75 and older, it's about $816.54 per month, thanks to the 10% top-up introduced in 2022. Same thing, OAS is taxed at your marginal rate, and unless you request voluntary withholding, nothing is deducted before the payment arrives in your account. RRSP and RRIF withdrawals are fully taxable income. Financial institutions do withhold tax on RRSP withdrawals and excess RRIF withdrawals, 10% on amounts up to $5,000, 20% on $5,001 to $15,000, and 30% on amounts over $15,000. But these withholding rates are often less than your actual marginal rate, once all your other retirement income is added together. Here's what this looks like in practice. Take Paul. He's 66 and just retired in January. He collects CPP of $950 a month and OAS of $742 a month. He also takes $2,000 a month from his RRSP to top up his income. He's asked for no voluntary withholding on his CPP or OAS, and the $2,000 RRSP withdrawal has 10% withheld at source. Total income, approximately $43,704 a year. Tax withheld at source, roughly $2,400 from RRSP only. But Paul's federal marginal rate in 2026 on income above $16,452 is 14% federally on the first $58,523. Add provincial tax on top, call it 9 to 11% depending where he lives, and his combined marginal rate is around 22 to 25%. On $43,704 of income, after the basic personal amount and pension income credits, Paul probably owes somewhere around $6,000 to $8,000 in combined federal and provincial tax. He paid $2,400 through withholding. That gap between what was withheld and what you actually owe is the single most common shock in a retiree's first tax season. Not because of anything unfair, because the payroll system that handled everything automatically no longer exists. What to do? Contact Service Canada and request voluntary tax withholding on your CPP and OAS payments. You choose the amount, and it can be adjusted. Do the same with your RRIF or RRSP provider, requesting that they withhold at a rate that matches your actual marginal bracket, rather than just the legal minimum. And if your previous year's tax owing was over $3,000, the CRA will want quarterly installments. They'll typically send you a notice, but you can also calculate them yourself or ask an accountant. The second change is one most Canadians don't think about until it's gone. When you were working, your employer may have been contributing to your retirement savings on your behalf, often without you thinking much about it. When you retire, those contributions stop permanently. But the way they stop matters, because different types of workplace pension plans stop in very different ways. If you had a defined benefit pension, your monthly income from that plan starts when you retire and continues for life, typically with inflation adjustments built in. The contributions are over, but the benefit continues. This is the strongest form of employer pension, and retirees with DB pensions are genuinely fortunate. They have predictable, guaranteed income that most Canadians don't have access to. If you had a defined contribution plan or group RRSP, the situation is different. Your employer was matching your contributions or adding funds every pay period during your working years. When you retire, the new contributions stop immediately. What's in the account is all you get. From that point on, the account's growth depends entirely on how it's invested and how you manage withdrawals. The employer's ongoing contribution, which may have been 3%, 4%, or 5% of your salary every year for decades, is gone. What a lot of people don't realize is how large that contribution stream actually was. Say your employer matched 4% of a $70,000 salary for 20 years. That's $2,800 per year in free money, and compounded over 20 years, it represents an enormous amount of retirement savings. When that stops, the gap in your annual wealth accumulation is significant. There's also a subtler loss many people miss: salary sacrifice opportunities. During your working years, you could contribute to your RRSP and potentially elect salary sacrifice arrangements, specifically to reduce your taxable employment income in the current year. That active deduction, using current employment income to fund tax-deferred savings, disappears in retirement because there's no longer any employment income to sacrifice. Your RRSP still exists in retirement, and you can still contribute if you have contribution room and earned income. But for most retirees, earned income drops sharply at retirement, and RRSP contribution room stops building once you stop working. What does this mean practically? If you're approaching retirement and you're in a defined contribution plan or group RRSP, the years immediately before your retirement date are often your last window to maximize employer matching and use any remaining RRSP room at the highest possible savings rate. Once those final paychecks end, So does the employer's contribution, and so does the ability to reduce your taxable employment income through RRSP contributions at the same pace. If you're already retired, the focus shifts entirely to managing what you have: the withdrawal sequencing, the account mix, the timing. And that's exactly what the next 3 changes are about. This is the change that generates the most angry comments whenever I cover it, because people feel blindsided by it. And honestly, they should. This is one of the most consequential tax rules in Canadian retirement, and most people don't hear about it until they've already lost money to it. Old age security is a government benefit paid to Canadians 65 and older who meet the residency requirements. In 2026, the maximum OAS is $742.31 per month for those 65 to 74, and about $816.54 per month for those 75 and older. That's roughly $8,900 to $9,800 a year, money you've earned the right to through decades of living and paying taxes in Canada. But there's a catch that doesn't get nearly enough attention. If your net income exceeds a certain threshold, the government starts taking OAS back. For the 2026 income year, that threshold is $95,323. Above that number, you lose 15 cents of OAS for every dollar your income is over the line. And at about $154,708, your entire OAS is clawed back to zero. Now, $95,323 may sound like a lot, but here's where people get caught off guard. Net income, specifically line 23600 of your tax return, adds up faster than most retirees expect because it includes everything: CPP, OAS itself, RRIF withdrawals, workplace pension income, interest income from non-registered GICs, dividends from investments, taxable capital gains from selling property or investments, any rental income, any part-time work. All of it goes into that one number, and all of it counts toward the clawback threshold. Here's a real example that shows how quickly it happens. Frances is 74. She has a modest defined benefit pension of $2,500 a month from her years as a nurse, which is $30,000 a year. She receives the full CPP at $1,100 a month, $13,200 a year. She receives OAS at $742.31 a month, $8,907 a year. And she has a RRIF worth $400,000 that she started at age 71. At age 74, her mandatory RRIF minimum is about 5.40%, which is roughly $21,600. Add those 4 sources together: $30,000 plus $13,200 plus $8,907 plus $21,600 equals $73,707. Frances is not in clawback territory yet, but now suppose she has a non-registered investment account that generates $5,000 in interest a year, and she decides to sell an investment with a capital gain of $40,000. Maybe a stock she's held for years that she wants to simplify. At a 50% inclusion rate, $20,000 of that gain is taxable. Her income now, $73,707 plus $5,000 plus $20,000 equals $98,707. She's over the $95,323 threshold by $3,384. At 15 cents per dollar, she loses $507.60 of OAS for the following payment year. That might not seem catastrophic, but if she makes the same move 2 years in a row, and if her RRIF minimum continues to rise as the percentage increases with age, the accumulation of income sources can push her further and further over the line, and the loss of OAS compounds. It affects her for a full 12 months following the reassessment. The income sources most likely to push retirees over the clawback threshold: RRIF mandatory minimums increase as a percentage every year, and if your RRIF account has grown, the dollar amount of the mandatory withdrawal also increases. Selling appreciated investments in a non-registered account triggers capital gains. Converting additional RRSP funds in retirement, a second property sold, an inheritance that includes a non-registered investment. What you can actually do. The most powerful tool is the one I covered in the previous video in this series. TFSA withdrawals do not count toward net income on line 23,600. They don't affect the OAS clawback calculation at all. Neither does the return of your own after-tax savings in a non-registered account, It's the income within those accounts that counts. If you need extra cash in a given year and you have TFSA assets, that's your first call, not an extra RRIF withdrawal. Pension income splitting is the second major tool. If you and your spouse are both 65 or older and have eligible pension income, RRIF withdrawals, or a registered pension plan, you can transfer up to 50% of that income to your lower earning spouse using CRA Form T1032. No money moves, it's a paper election, but it can reduce the higher earner's net income enough to fall under the $95,323 threshold entirely, saving the entire OAS amount every year. And here's the important part. You can make a different splitting election every single year. Whatever combination minimizes total household tax in a given year, that's what you elect. This change is a bit different from the first three because it goes both ways. Some tax credits and benefits decrease in retirement, depending on your income. Others actually become available for the first time when you retire. Let's go through the ones that matter most. The age amount, a new credit you gain. Once you turn 65, you become eligible for the federal age amount tax credit on line 31,100 of your T1 return. For 2026, the base amount is $8,396, and it generates a federal tax credit at the lowest tax rate, now 14% in 2026, worth up to approximately $1,175 in federal tax savings. Here's the catch. It starts to be reduced once your net income exceeds approximately $45,522 in 2026. Above that level, the credit is gradually reduced. By the time your income reaches approximately $105,709, the age amount is completely phased out. So the age amount is a meaningful credit, but only for retirees with modest to moderate income. Once RRIF minimums, pension, CPP, and OAS are all stacked together, higher income retirees often see this credit disappear partially or entirely. The pension income tax credit, another credit you gain. If you're 65 or older and you receive eligible pension income, RRIF withdrawals, lifetime pension payments from a registered pension plan, you can claim the pension income amount on line 300-1400. This credit allows you to claim 15% on up to $2,000 of eligible pension income, generating up to $300 in federal tax savings per person per year. This is one reason that pension income splitting is so powerful for couples. Before splitting, only the higher income spouse claims the pension income credit. After splitting, both spouses can claim it, meaning the couple gets two credits of up to $300 each federally, for a combined saving of up to $600, plus provincial equivalents. The medical expense tax credit often increases in retirement. The medical expense tax credit is a non-refundable credit for out-of-pocket medical costs above a certain floor. In retirement, healthcare costs tend to increase. Prescriptions, dental, vision, hearing aids, physiotherapy. These expenses, to the extent they exceed 3% of your net income, or approximately $2,759 for the 2026 tax year, whichever is less, become creditable. Many retirees underclaim this credit simply because they don't know what qualifies. The CRA's list of eligible medical expenses is long. Prescribed drugs, dental work, ambulance services, medical devices, attendant care, home modifications for a disability, and more. Keeping receipts and reviewing them at tax time is genuinely worth the effort. GIS, a benefit that can appear, but only if income is low enough. The Guaranteed Income Supplement is a non-taxable monthly payment for OAS recipients with low net income. In 2026, the maximum is $1,109.85 per month for a single senior. That's over $13,000 a year, completely tax-free. GIS is only available if your income is below a certain threshold. For single seniors in 2026, GIS begins to be reduced at a combined income above approximately $22,056, excluding OAS itself. It's reduced by 50 cents for every dollar of other income. For retirees who are eligible, GIS is significant, but it's extraordinarily sensitive to income planning. A poorly timed RRSP or RRIF withdrawal can cost more in lost GIS than the withdrawal was worth after tax. This is another area where the TFSA is the critical tool. TFSA withdrawals don't count as income for GIS purposes. For a retiree who is close to the GIS threshold, pulling supplemental cash from a TFSA instead of a RRIF can preserve thousands of dollars in GIS that would otherwise be clawed back. Provincial programs vary, and many retirees miss them entirely. Every province has its own suite of income-tested benefits for seniors. Property tax credits, renter rebates, pharmacare programs, transit credits, dental programs. These programs often use the net income from your federal return as the qualifying figure. Managing your federal net income through TFSA use, RRIF timing, and pension splitting often unlocks or preserves provincial benefits at the same time. If you're not checking what your province offers each year, you may be leaving money on the table. I saved this one for last because it's the change that has the biggest financial consequences, and it's the one retirees most consistently underestimate. Here's the core of the problem. During your working years, your RRSP was a savings account. You put money in, it grew tax-deferred, and you didn't think much about timing. The government let you defer the tax bill, and you are happy to let it sit. When you reach age 71, the deferral ends. You must convert your RRSP to a RRIF by December 31st of the year you turn 71. And from the very next year, you must begin withdrawing a minimum amount every single year, with no exceptions. The mandatory minimum is a percentage of your RRIF's January 1st balance, set by the CRA based on your age. These are the 2026 prescribed withdrawal factors. Age 71, 5.28%. Age 72, 5.40%. Age 75, 5.82%. Age 80, 6.82%. Age 85, 8.51%. Age 90, 11.92%. Age 95 and older, 20%. Every dollar that comes out is fully taxable income. No exceptions. And here's the critical detail. There is no tax withheld at source on the minimum amount. Your institution sends you the entire minimum, and you owe the tax at the end of the year. Let's put some real numbers on what this means. Example 1. The mid-size RRIF. Gordon is 73. His RRIF balance on January 1st is $450,000. The mandatory withdrawal rate at age 73 is 5.53%. He must take out $24,885 this year. Add his CPP of $1,000 a month, $12,000 a year, and OAS of $742 a month, $8,907 a year, and his income is already $45,792 before pension income, investment income, or any other source. He also has a small workplace pension of $1,200 a month, $14,400 a year. Total, $60,192. He's comfortably below the OAS clawback threshold and paying combined federal plus provincial tax of roughly 22 to 30%, depending on his province. But here's where it gets more serious as the years go on. Example 2. The unplanned RRIF at 80. Gordon is now 80. His RRIF has grown. His investments performed well, and he's been taking only the minimums. His balance is now $480,000. The mandatory minimum at 80 is 6.82%. That's $32,736 this year. Add the same CPP, $12,000, and OAS, $9,799 a year at 75 plus, and pension, $14,400. Total income is now $68,935. He's still below the OAS clawback threshold, but he's significantly closer to it. Add 1 year where he sells an investment or takes an extra withdrawal, and he's over the line. The problem compounds because the minimum percentage keeps rising, even if the account balance stays the same. A retiree who started retirement with a modest RRIF may find that by age 85 or 90, the mandatory withdrawal represents a substantial portion of the account every year, and every dollar of it is taxable income. The 3 specific mistakes retirees make with RRIF withdrawals. Mistake 1. Waiting until 71 to think about it. The years between retirement and 71, if you retired at 60, 62, 65, are a window to voluntarily draw down your RRSP at a lower tax rate and move the proceeds into a TFSA. Every dollar you shift into a TFSA before 71 is a dollar that won't generate a forced, fully taxable withdrawal later. It's also a dollar that will never count against your OAS or GIS. Mistake 2. Not using the younger spouse's age. When you set up your RRIF, you can elect to base your mandatory minimum on your spouse's age rather than your own. But only if your spouse is younger and only if you make the election before your very first RRIF payment. A younger spouse's lower age factor means a lower mandatory minimum each year, which means lower taxable income, lower tax, and a better chance of staying under the OAS clawback threshold. Once you've started taking RRIF payments, you cannot change this election. If your spouse is younger and you're setting up a RRIF, ask about this before the first payment comes out. Mistake 3. Taking extra withdrawals in the wrong years. If you need more money than the RRIF minimum provides, the instinct is to simply take a larger RRIF withdrawal. Sometimes that's the right call, but compare it first to what you have in a TFSA. RRIF withdrawals over the minimum are subject to withholding tax, 10%, 20%, or 30% depending on the amount. TFSA withdrawals have no withholding and don't appear on line 23600 at all. The year your income is likely to be highest, say because you sold a property, or received an inheritance, or had a large capital gain, is exactly the wrong year to take an extra RRIF withdrawal if you can avoid it. The good news in all of this: RRIF rules give you several legitimate planning levers: voluntary early drawdown, younger spouse selection, coordinating extra withdrawals with low-income years, moving minimums to the TFSA rather than spending them. None of these are complicated when you understand them, but none of them are automatic. You have to know they exist and choose to use them. Before we close, I want to spend a minute on something important. For all of the changes I've described, and they are real, and they do cost people money, there's a lot that retirement doesn't take away. The TFSA stays. Every dollar in your TFSA continues to grow tax-free. Every withdrawal continues to be invisible on line 23600. If you haven't maximized your TFSA room by retirement, it remains one of the most powerful moves you can make in your early retirement years. CPP stays. You earned it through decades of contributions. It's indexed to inflation every January. It pays for life. And you can even continue contributing to CPP if you're working after 65 and before 70, earning post-retirement benefit credits. OAS stays, as long as your income stays managed. Knowing the $95,323 threshold and planning around it means you keep the benefit. The pension income tax credit stays, up to $300 federal per person, doubled for splitting couples. The age amount stays, as long as your income stays below the phase-out range. Capital gains planning stays. The 50% inclusion rate on capital gains is still in place for 2026. Planning which years to realize gains and pairing them with available losses remains a legitimate and powerful tool. Pension income splitting stays. The ability to shift up to 50% of eligible pension income to a lower earning spouse stays in place as long as you're both alive, both residents of Canada, and elected on your return. These tools exist specifically to support Canadian retirees. They're in the tax code because the government put them there. The only reason most people don't use them fully is that nobody walked them through how they work together. 1. Request voluntary tax withholding on your CPP and OAS payments if you know you'll owe tax. Do the same with your RRIF provider. Eliminate April surprises. 2. If you're retiring before 71, look at your RRSP balance now. Calculate whether voluntary early withdrawals at a lower rate in a lower income year make sense before the mandatory RRIF minimum kicks in. 3. If your spouse is younger and you're setting up a RRIF, ask your institution about electing the younger age before the first payment, not after. 4. Check your TFSA contribution room in your CRA My Account. If you have unused room, prioritize filling it, especially with investments that produce regular taxable income. 5. Before you sell any non-registered investments, model what the capital gain will do to your net income. If it pushes you over $95,323, Consider whether the sale could be spread over 2 tax years. 6. Complete CRA Form T1032, the joint election to split pension income with your spouse every year you have eligible pension income. Revisit the percentage each year based on that year's income combination. 7. Review the medical expenses you paid in the year. The list of eligible expenses is longer than most people realize, and in retirement, out-of-pocket health costs often exceed the threshold where the credit becomes valuable. 8. Check what your province offers for senior benefits each year. Pharmacare, property tax rebates, dental programs, many are tied to the federal net income figure that all of the above strategies can help manage. 9. Keep your tax records for at least 6 years from the end of the relevant tax year. Even as a retiree, the CRA can review prior years. 10. If your income is close to any of the thresholds we discussed, the OAS clawback at $95,323, the age amount phase-out starting around $45,522, or the GIS income ceiling, book a session with a fee-only financial planner or tax professional. Even one well-timed planning decision can be worth many times the cost of professional advice. Drop a comment below. Did any of these 5 changes surprise you? Type the number of the one that hit closest to home. I read every comment. Subscribe for plain English breakdowns of CRA rules, CPP, OAS, RRIF, and Canadian retirement planning every week.